June 25, 2002. WorldCom admits to fraudulent accounting adjustments totaling $11 billion. The largest accounting fraud in U.S. corporate history. $175 billion in market value evaporates. Investors in 110 countries lose everything. And for 17,000 employees, the collapse wouldn't arrive as a memo, but as a locked door. This is not derivative complexity, not a bank run. This is basic ledger fraud, manual journal entries, executed in systems designed to trust. The company began as long-distance discount services in 1983. Hattiesburg, Mississippi, a small telecom reseller in the aftermath of AT&T's breakup. The deregulation of long-distance telephony created space for competition. LDDS entered that space. Bernard Ebbers, a former basketball coach and motel operator, took control in 1985. His strategy: use company stock as acquisition currency, consolidate competitors, scale rapidly. The company went public in 1989, providing the equity base for expansion. By 1995, LDDS acquired WillTel. In 1998, it completed a $37 billion merger with MCI, the largest corporate merger in history at that time. In 2000, the European Union and U.S. Department of Justice blocked WorldCom's proposed acquisition of Sprint. The acquisition engine stopped. For years, new revenue from mergers had masked deteriorating operational margins. The telecom market was saturated. The dot-com bubble had burst. Revenue growth organically was no longer possible. But Wall Street expected double-digit growth, quarterly. According to SEC filings, management chose fabrication over disclosure. WorldCom's largest expense category: line costs. These are fees paid to other telecommunications carriers to access their networks. In a healthy telecom business, line costs should decline as a percentage of revenue as the company scales. At WorldCom, the ratio was increasing, a sign of pricing pressure and market saturation. Reporting this accurately would have revealed negative operating income. The first manipulation: improper use of accrued reserves. Reserves are liability accounts set aside for anticipated future costs. Under GAAP, they can only be reversed when the obligation no longer exists. In 2000, CFO Scott Sullivan ordered $828 million in reserves to be released. First entry: $828 million. The reversal was credited against line costs, artificially reducing reported expenses. According to the SEC investigation, there was no underlying economic event, no contractual change, no vendor renegotiation. The entries existed solely to reach the quarterly earnings target. The second method was systematic and larger in scale. Operating expenses reduce profit immediately. Capital expenditures are recorded as assets and depreciated over time. This is the fundamental distinction between OPEX and CAPEX. Beginning in 2001, Sullivan's team began transferring line costs from the income statement to the balance sheet. The costs were reclassified as capital assets under the label prepaid capacity, a fictitious account. Between 2001 and the first quarter of 2002, $3.8 billion in line costs were capitalized. Total fraud: $4.6 billion. First quarter 2002. WorldCom reported net income of $130 million. Analysts were satisfied. The stock stabilized temporarily. Without the fraudulent capitalizations, the company had lost $395 million. On paper, the balance sheet showed billions in telecom infrastructure assets. In reality, these were unpaid phone bills. The enterprise resource planning system had no automated control to prevent an operating expense from being reclassified as a capital asset. Journal entries were manual. They required no supporting invoice, no vendor confirmation, no approval beyond Sullivan's authorization. The system trusted the entry. Internal audit operated on a scheduled review cycle. They had no real-time visibility into entries as they were posted. Arthur Anderson, WorldCom's external auditor, conducted annual audits. Arthur Andersen was not an impartial observer. At the same time, the firm was facing global scrutiny for the collapse of Enron. There was a systemic conflict. Andersen received millions in consulting fees from WorldCom, creating a financial incentive not to aggressively question the irregularities. The fall of WorldCom was the final blow. Negligence in both cases led to the firm's conviction for obstruction of justice and its total dissolution, reducing the Big Five accounting firms to just 4. The firm tested samples, verified supporting documentation provided by management, relied on representations from CFO Scott Sullivan. The audit model assumes honest disclosure. When management systematically fabricates documentation, the control structure fails. There was no mechanism for real-time detection of fraudulent classification. March 2002. Cynthia Cooper, Vice President of Internal Audit, received information from the head of the wireless division. $400 million in reserves had been released to inflate the division's reported income. The allocation had no documented basis. Cooper and her team, Glynn Smith and Gene Morse, began investigating after business hours. They worked at night to avoid alerting Sullivan's finance group. Gene Morse queried the capital expenditure accounts. He found a $500 million entry coded as computer equipment purchases. There were no purchase orders, no vendor invoices, no IT department authorization, just a journal entry, posted manually. Deeper analysis uncovered the term prepaid capacity, repeated across dozens of entries. Using T-account reconstructions, Cooper's team traced 49 separate fraudulent capitalizations. Total, $3.8 billion. Several entries carried the notation SS, Scott Sullivan's initials. And when they realized what they were holding, she copied the evidence onto hard drives before anyone could make it vanish. Cooper requested a meeting with Scott Sullivan to review the findings. Sullivan instructed her to postpone the review until the third quarter. A delay tactic, a signal of obstruction. Cooper bypassed Sullivan. She escalated directly to the audit committee of the board of directors. On June 24, 2002, she presented the evidence. 49 fraudulent entries, $3.8 billion in false capitalizations, $828 million in improper reserve releases. Further investigation by external counsel identified additional manipulations. The total reached $11 billion. $11 billion. At this point, the fraud was undeniable. The documentation existed. The entries were traceable. Recovery was no longer possible. June 25, 2002. WorldCom issued a public statement disclosing the accounting irregularities. The SEC had been investigating the company since March on unrelated matters. This disclosure confirmed systemic fraud. The stock, trading at $7 per share, collapsed to less than 10 cents. Institutional investors holding WorldCom bonds saw valuations disintegrate. According to court filings, the company carried $30 billion in debt. No lender would extend credit. No investor would provide liquidity. July 21, 2002. WorldCom filed for Chapter 11, bankruptcy protection. The largest bankruptcy filing in United States history. 17,000 employees were terminated immediately. Clinton, Mississippi, the company's headquarters, lost its largest employer. Tax revenue disappeared. Suppliers went unpaid. The local economy contracted. Bernard Ebbers was indicted on 9 counts: securities fraud, conspiracy, and false regulatory filings. His defense: he was unaware of the accounting details. He relied entirely on Scott Sullivan's representations. Prosecutors presented internal emails showing Ebbers demanding that quarterly targets be met, regardless of operational reality. Former employees testified that the pressure to manipulate results came directly from the CEO's office. WorldCom collapsed within months of Enron's bankruptcy. The failures created legislative urgency. July 30, 2002. President George W. Bush signed the Sarbanes-Oxley Act into law, the most significant corporate governance reform since the Securities Act of 1933. Section 302. Chief executives and financial officers must personally certify the accuracy of financial statements. Knowingly certifying false statements, up to 20 years imprisonment. Section 404. Public companies must establish, document, and test internal controls over financial reporting. External auditors must attest to the effectiveness of those controls. The Public Company Accounting Oversight Board was established to regulate auditors. Audit firms were prohibited from providing certain consulting services to their audit clients. The conflict of interest that enabled Anderson's failure was legislated out of existence. Federal whistleblower protections were codified. Employees reporting fraud gained legal recourse against retaliation. Cynthia Cooper was named one of Time magazine's Persons of the Year in 2002, alongside Sharon Watkins of Enron and Colleen Rowley of the FBI. In her memoir, Cooper described the period as isolating. She was ostracized within the company, suffered depression, received threats. The recognition came only after the damage was complete. July 13, 2005. United States District Judge Barbara Jones sentenced Bernard Ebbers to 25 years in federal prison, the longest sentence ever imposed on a corporate executive at that time. Ebbers served 13 years before being released on compassionate grounds in December 2019. He died in February 2020. Scott Sullivan, who testified against Ebbers, received a reduced sentence of 5 years. Controller David Myers received 1 year and 1 day. Staff accountants, including Betty Vinson, received sentences ranging from probation to 5 months. Court records show Vinson and others acted under duress, fearing termination if they refused Sullivan's orders. In 2006, Verizon Communications acquired MCI, the post-bankruptcy entity that emerged from WorldCom's restructuring. The purchase price was a fraction of WorldCom's peak market capitalization. The Securities and Exchange Commission's settlement with WorldCom recovered $750 million, the largest disgorgement in the agency's history at that time. Funds were distributed to defrauded investors. WorldCom's fraud required no offshore structures, no synthetic derivatives, no algorithmic concealment. The mechanism was manual journal entries. The system allowed it because the system was designed to trust authorized users. External auditors relied on management assertions. Internal auditors had no real-time monitoring capability. $11 billion were hidden using entries that every junior accountant is trained to post. Sarbanes-Oxley restructured the accountability architecture. Section 404 shifted the burden from personnel trust to system verification. The assumption changed. Controls must be independently validated, not simply asserted. At WorldCom, the failure was structural. The ledger was trusted. The auditors were constrained. The whistleblowers were silenced. Until one was not.